Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, really any kind of real estate investor, whether you're on the passive or the active side, well, this is the one real estate YouTube show and podcast that was designed especially for you to keep you up to date with all of the latest information, research reports, all the data, all the articles, so you can make the most informed decisions when you're thinking about making a real estate investment or you're trying to just figure out what's going on in this crazy market that we're seeing. We've got a lot of really great reports today, stuff from Capital, Spectator, the White House, Cushman & Wakefield, Colliers, Marcus & Millichap, RealPage, NAR. A lot of good stuff today. Let's get into it. All right, we're bringing it back in. We got Matt Bosnagel joining us once again, Director of Communications and Marketing here at Gray Capital, but also just in general, the mastermind behind the Gray Report, kind of coordinating all of this research, aggregating all of these reports. It takes a lot of effort. We got a whole team, but really it's all Matt. Matt, again, thanks again. This is a great set of reports. Now, these are going to be sent out tomorrow in the newsletter, right?
Yep, correct.
The Gray Report newsletter provided by Gray Capital. You can sign up for at graycapitalllc.com/newsletter. Do that after you've given this video a like, you subscribed, you're hooked into the podcast, and leave a comment with, any kind of question, or something, a topic. We'll cover it. How's your week gone so far, Matt? How you doing, man?
Pretty good. I think we're all doing pretty good.
We're getting there. We're getting there. We're almost there.
And in the economy, it may not be doom. So
maybe not all doom and gloom. That would be great. So let's get right into that. Capital Spectator had this interesting piece out. Early Q2 GDP nowcasts point to rebound for U.S. economy. I mean, they're essentially saying, Matt, after Q1's contraction in real GDP growth, we're looking at possibly not a contraction, I think is what they're saying. Man, now they're targeting kind of like on average. And they're taking the average of like a lot of different forecasts, but they're thinking maybe around 2.6.
You know what? This is not the disaster that we've been hearing about. I think also it's important to take in a lot of different perspectives. What I'm pulling from this is, nowcast or forecast or whatever, or past cast, whatever it is, it's not saying that we're never going to get in trouble economically. But maybe when we're talking about Q3 or Q4 or maybe into 2023, if there is a recession or a downturn, it's not going to be as hard as people might have predicted.
Yeah.
But I think that's kind of what I got out of that, is that this kind of long-term thing that people, that's where the real danger zone is. Mm-hmm. And if it's lessened now, or if we're doing a little bit better now, I'd like to think that it's not that we're going to crash. It's that maybe we'll be able to absorb
maybe this soft landing that Jerome Powell is hinting
right.
at. That would be something. That's I guess in contrast to Goldman Sachs came out a couple days ago forecasting. Mm-hmm. They're forecasting a recession possibly in kind of the near future. But a lot of other folks are saying, okay, yeah, there's definitely the ingredients for a recession, but 2022, maybe not, maybe 2023. Mm-hmm. And I think maybe that's maybe some hedging of bets of it's harder to make a call in the short term, and it's a little bit easier to say like, okay, yeah, there will be a recession eventually because that's kind of a truth.
Yeah. But there's always gonna be bad things that happen. Yeah. But I do think that there is also like a momentum to the economy. It's not like things just went out from under people, short of maybe some crypto and growth investors, but like it wasn't like the financial crisis where people were suddenly underwater in their mortgages. There's a lot of savings out there that people have that could also further cushion the blow.
Yeah. Now, what people are pointing to in terms of like things not looking great but not looking horrible is this looking at this economic momentum index, the economic trend index. And it shows a pretty, big decline compared to October 2021. Now, I think right now we're kind of at the kind of 65% threshold. And I believe 50% would be an indicator of a potential recession. And so it's kind of flattening out here, the last month or so. but this is something we're going to have to watch because I wouldn't say it's completely dropping off, but certainly, the momentum, at least according to this chart, has declined.
Yeah.
And, looking at, this graph as well, again, it's the zero line is, potential recession. We're definitely on the downswing, but, there's plenty of times where we've, for example, in the mid 90s where it's kind of come down quite a bit and then it's bounced back up. And that happened kind of in the last cycle as well, as we had kind of a big decline. This is probably like 2015, 2016. There's not an exact date on it. But then, we recovered. So, these indicators, they oftentimes don't work until like you're already in it. So you have to take it with a little bit of a grain of salt. But it's certainly something we need to keep watching out for.
Yeah. I think that if anything, what it seems like, it doesn't seem like there's going to be a miracle. I guess that's by definition, not unlikely, but it doesn't seem like it's going to reverse itself that much soon. I think these trends will continue, but maybe peter out towards a bottom rather than spiking straight down to a bottom.
Yeah, I think that's the case. Save some just black swan event, another one that we don't really know about. Okay, so for the next piece on the report, piece out from the White House on. They've got a plan for housing, but it doesn't seem like concrete like steps of, okay, this is what we're doing today. It's like, here's an idea that we have. So Matt, tell us a little bit about this, the plan.
Yeah, I mean, again, this is just a plan, and it's not necessarily a reflection of immediate action that they're going to take, but I think it does state their direction that their policy making might take. This will take a lot of work as well. Just to highlight some components of the plan that they pulled out in their summary, this plan constitutes they'd like to reward jurisdictions that have reformed zoning and land use policies, deploy new financing mechanisms to build and preserve more housing where financing gaps currently exist, expand and improve existing forms of federal financing, including for affordable multifamily development and preservation, ensure that more government-owned supply of homes and other housing go to owners who will live in them, and they want to work with the private sector to address supply chain challenges and improve building techniques to finish construction in 2022 on the most new homes in any year since 2006. This is just words on a page. But when that page has White House letterhead, sometimes, not all the times, sometimes they can help you predict future policy decisions. So this is again a thought experiment under the assumption that this plan will have policy effects, which there's a lot of, they're going against the grain in some places, whether if they're going to want to turn this into legislation, maybe executive action, but there might be some congressional hurdles. Anyway, what kind of effect can we hope for? Ideally, less regulatory hurdles and more attractive housing financing could be really powerful here. But I think that ensuring that government-supported housing goes to owners who will live in them, that might take some kind of bureaucratic effort. I don't think it would be a huge drag on the investment market, but that's going to take time and money to accomplish.
I think the government getting involved in who can buy something from who and what. I just think that's not the role of the government to know who should be the one who buys this home or not. Because that's assuming that home ownership is the preferred housing choice, and that is empirically the best. The best financial decision for someone. When we clearly see the evidence right now that it's much more affordable to rent than it is to buy. Mm-hmm. So. I think this is just a bad plan. In general, I'm sure some of the incentive, we need to get rid of the regulation in terms of being able to develop more, kind of get rid of the red tape, so we can get rid of the NIMBYism, which is really a local issue. A lot of this is just local stuff. If you want to spend some money for more housing, that's fine. It's probably not going to fix anything. Getting rid of the red tape is going to be much more effective. And but a government assistance on building affordable housing makes sense. You just got to let us do it. And getting in the way of saying who's allowed to buy a house and who's not allowed to buy a house. That's to me that's how you make things unaffordable, and that's how you screw a market up.
Well, that's what I was going to say is so every regulatory hurdle they take away, they add one back.
Take one away, add two.
That's exactly right. So I think that it would be nice if maybe some of the policy decisions that did work were implemented.
Yeah.
I think the mere fact that they're actually kind of talking about some of this stuff is great.
That's a good point.
But again, I think that this will largely depend maybe on localities.
Yeah. And just, I guess, to me, it's maybe also important, just because this is such a popular topic, is to maybe to discuss what's not in this plan. And that's like some national rent control thing that you hear people talk about. True. And I just don't see how that's constitutionally would be allowed, outside for, again, federally subsidized like housing. They can do whatever they want because they're giving you money. But to go into a municipality and say, we're going to, get in the way of kind of your the way that you handle housing at a local level. I just don't think there's any authority in the Constitution for that.
I think that there is, like, they pretty much allow the private market to be the main producers of housing in this plan as they describe it. It's not them making all of the rules, and I guess I don't want to be grateful for that, but I think that even they can't kind of
I think they acknowledge the limitation and how politically, because they know it's a bad idea. I'd imagine. I think they probably had some economists begrudgingly tell them like, that doesn't work. So we probably, and you can't. Not only does it not work, but you can't do it, and it's a local decision. If you want to screw up your housing market, that's up for you and your local politicians to decide to do. Okay, so Cushman & Wakefield, how Generation Z is fueling the demand for multifamily. Well, they're kind of in that prime renting age, so that makes sense that they are pouring fuel on the fire, because the millennials are still renting. They're not buying homes, or at least in droves, even if they want to, just because they can't afford them. So, Matt, I don't want to steal the thunder, but I'm just curious. What Gen Z? Do they know what they want?
What does Gen Z want? For how many years have we suffered these articles that asks what do millennials want? Like, what in their avocado? I never really eat avocado toast. It's not like I'll turn it down.
I don't get avocado toast now just because of the stigma. I'm like, I can't. You've ruined it for me. I love avocados. Right. I love some toast, but I'm like, I don't want to be the millennial literally ordering avocado toast. I don't know how that became.
I think this is what how I would characterize this article. It's more about new trends than trends that are unique to Gen Z. But
avocado toast is out.
It's out. It's not. I don't even know what they're eating. Computer chips,
NFTs, and G Fuel. I don't know.
But they do know that, and this is a reminder, and we've kind of known this. Gen Z is going to be in their prime renting years, and they're going to make the largest group of renters in not very long from now. So in 2025, Gen Z is expected to be 31% of the rental market, just 2% less than millennials. And in 2030, they're going to have 44% of the rental market, far more really than the millennial share of 26%. So again, they do ask the same question that everyone's asking, is what does Gen Z want? And I do think that it is more interesting to think about them as young people rather than as like this kind of distinct group, because then you start to bleed over into just general cultural trends. But they do say, and a lot of these articles mention, the first thing they mention is high internet speeds. I think we all want high internet speeds. And they say sustainability, which is that's a broad cultural trend as well. I just think that instead of millennial roommates of 2008 and 2010, we may see higher apartment demand from Gen Z, because the one thing that they do highlight in this article is that they are more likely to live alone. So if they're not having roommates, and that may be financially determined, but if they're not having roommates, then that's more household formation.
I wonder why are they living alone? They're okay. They can text.
Yeah, they're millennials are a needy generation.
Oh yeah, okay, and
it's just the opposite. Okay. Gen Z.
Got it. Okay,
they're the generation that's going to save us.
Hey, great. That's good. We all need it. Okay, Colliers Capital Markets Report Q1 2022, and just a reminder, if you're like, hey, I want to go deeper into these reports, just sign up for the newsletter, graycapitalllc.com/newsletter, or you can go just directly to grayreport.com. It's updated throughout the day, all the reports, all right there. Go check it out, greatreport.com. Obviously, after giving this video a like, it really helps the channel, gets this information out to more folks. Really, really important. We appreciate your help. Okay, again, back to Colliers Capital Markets Report.
Yeah.
Snapshot.
So, yeah, this is really a quick snapshot. This is an 8-page report compared to Newmark's Capital Markets 35-page report. But it still does a decent job of highlighting some of the sales volume numbers, and really you can tell that multifamily has done great this year. They record the same $63 billion in investment as
quarterly volume.
As Newmark, and here's another few interesting figures for multifamily specifically. Prices increased by 22.4% compared to last year. We see a lot of numbers on rent growth and things like that, but
how does that translate to price growth?
Exactly. Yeah. So that's the kind of ballpark figure that they give us there. Gray Report listeners will also already be familiar with the subjects listed under their what to watch label: single-family mortgages, housing starts, and housing affordability. That these are big deals that are only going to get bigger, and they have been big deals really for the past few months. One thing that I think is interesting, and this is something, again, that we have covered, is rising interest rates are perhaps most impactful on the multifamily side where cap rates are low. I don't want to say we called it, but we do agree. The implied logic behind that statement seems to be that property types with lower cap rates are more likely to be impacted by rising interest rates. I think it'll be interesting to see how this logic plays out, if it can fit other groups, because if the low cap rates of multifamily properties as a whole makes them more attractive or makes rate hikes more impactful, then what about individual multifamily markets? Will the multifamily market in trendy Phoenix or Miami be hit before those in Kansas City or Grand Rapids?
Yeah, I think that's a great point. Is that the kind of the ultra low, high flying markets are going to see the biggest kind of shakeup, just because the cap rates are just unsustainable with these higher interest rates. You just can't pencil the deals with 0% rates. Yeah, you can make that work, but with 5% interest rate, that just, that dog won't hunt.
Yeah, it is interesting. We're seeing some kind of hard limit here, and there are limitations. I've been reading a lot of articles that are kind of saying, these rising interest rates aren't going to really have, if you look at it in the long term, but there are some discrete effects. Maybe you'll see them on the margins. Maybe you'll see them in a low time scale, but it does have an impact. It's impossible to say that it doesn't. Yeah. And I think that it sometimes means a little bit of a rise in cap rates in some areas.
Yeah. I think we've already seen it across markets. I think this report, like many of the reports we've seen, are a little bit out of date just because it's happened too fast. They don't have time to get the data, to be honest. Okay, Marcus and Millichap, another great video from John Chang. Again, really highly recommend you watch their videos, get their reports. We usually include them in the Gray Report newsletter, as we said.
As I was writing about this, I was thinking this is going to be another short, 2-minute video that we spend a half an hour discussing. Because not only does they're touching on some really relevant topics here, and they're breaking things down into a lot of other issues in and of themselves would be really great to talk about. So again, he talks about the idea that cap rates are not necessarily correlated with interest rates. And I think that while there's some merit to that idea, it doesn't completely hold true. I think that one person's sum may be different than another. We get a similar graph of the 10-year Treasury against CRE cap rates that we saw last week in the Newmark report. And I'm not arguing that the larger point about interest rates and cap rates is true or not. I think it is true when it comes to long-term trends, but I do think that there's some wiggle room in this correlation. The 10-year Treasury is a useful benchmark, but it's not the exact metric that, for instance, multifamily loans are based on.
Yeah, they don't move in lockstep. They are, somewhat correlated. I mean, you see kind of this downward trend, but not always, because things happen in the multifamily market that might be different in the bond market, and they're not, multifamily and real estate in general is a little bit insulated. But there becomes a point of where they do matter. And I think that's the bottom line of at the end of the day, cost of capital matters. And like we talked about last week, yeah, the 10-year Treasury is really important, but it's, really looking at those shorter term rates, like SOFR and kind of which is kind of sort of more closely based on Fed funds rate. That's what's really pushing cap rates, because that's like 0% super low.
Yeah.
That free money just isn't available. It's not there. And so you can't make those incredibly skinny deals work. But just this also highlights, just going back in time a little bit, we had one of the best buying opportunities back in 2020 when interest rate spreads were at an all-time high. And we know that, quite a few investors, including great capital investors, took advantage of that opportunity.
Mm-hmm. I think that this is a story about long-term and short-term trends, and by the impression that I get when I was considering his graph there is that we'll see it coming. Yeah. These cap rate trends, they act on there are two trajectories basically. There is kind of a near-term ups and downs, but in the long term, we'll know where the general cap rate trends are headed.
Yeah.
Also, he goes into 4 factors when considering cap rates. One is how much capital is available. More capital often leads to lower cap rates. I think there's a lot of dry powder out there, specifically in the multifamily market, that could, again, over the long term, mean that cap rates stay pretty low. And we also just covered the record-breaking sales volumes in the multifamily market in the first quarter of this year. So there's a lot of capital that has been put to work this year.
Yeah.
But what's the alternative viewpoint? Again, I don't want to say that we called it last week. I just want to say that that it does not take an investment genius to compare the benefits of CRE investments in our current environment with less attractive investments. There's a lot of capital that's been put to work this year. There's a lot of capital that's coming in from people seeing CRE as an alternative. So I would definitely project that investors will be drawn away from these less attractive investments into CRE investments.
Commercial real estate versus the S&P. I mean, we're looking at a graph right now, if you are watching or you're listening, comparing the S&P 500 total returns versus commercial real estate in general. Now, I'd be curious to see how they calculate that commercial real estate total returns, aggregate all that. But, okay.
If you normalize it, kind of at any one point, I think.
Either way, according to their data and metrics, I mean, commercial real estate just crushes the S&P 500. And this is not taking into account tax advantages. I'll say that. So
and especially I think that no matter what the busyness of that chart was, there is a distinct and observable dip in the stock market in the past 6 months, it did not happen in the CRE market.
No, it did not. I mean, obviously there's some turbulence right now, but it's nothing like you're seeing in the public markets.
And then the final one that I want to note that he talks about is demographics. And my mind usually snaps to renter populations when I hear the word demographics. But John Chang makes a solid point about investor demographics, saying that as baby boomers retire, they're looking for reliable cash flow. So it's not just like the renter populations or whoever's going to be occupying a particular property. It is the appetite from investors that may increase as people look for cash flows. And specifically, he singled out single tenant net lease properties as a clear beneficiary for this cash flow oriented.
Well, I think that's part of all the discussion we've had in the past of the demand from investors. We're looking at the renter demand and the investor demand, and the investor amount of demand from investors is really kind of putting a ceiling on the cap rates. And so they can rise a little bit, but then, I mean, I just knowing real estate investors, they see these higher cap rates, just slightly higher cap rates. And it's like, this is a great opportunity because, interest rates, they're higher, but I can still make deals work. They're not so high. It's a great buying opportunity. So I still see people making deals happen and making it work. So very interesting. What do you think? You want to move on to RealPage?
Yeah, definitely. So this article is at first I didn't think it would be as interesting, and then I really got into this one. It's a discrete topic talking about renewals, and I'm as excited about it as rent growth. Let me tell you.
It's important. So, what are people staying in their apartment?
Yeah. So more than 57% of market rate renters with an expiring lease renewed over the last 12 months, which is up 3.5 percentage points year over year, according to rent rolls running on the RealPage platform. By comparison, apartment retention between 2010 to 2019 was 51.5 before it kind of soared during.
Yeah, I was going to say, we think of 50% renewal rate as kind of like the average. 57, that's quite a bit. I mean, that makes sense because you're typically not going to be charged as much if you stay in your apartment because the owner, the landlord it takes time and money to, for it to go vacant and from to lease it up and to fix it up. So they're like, hey, look, I'm not going to charge you the full $100 increase, but hey, okay, here's $50.
Yeah.
And so instead of on a percentage basis, okay, yeah, market rents have increased 15%, but on renewals, maybe only going to increase the rent 5%, 7%, something like that.
And they say that, they note that specifically right here, is they say that renewers paid 10.7% more compared to their previous lease, which is a large increase, but it's substantially below the 18.7% hike a typical new renter paid compared to previous residents of the same unit. This was, I think, when they break down who is paying higher renewal increases, was particularly revealing in that at A and B, renewal prices went up by 11 to 12%, while Class C properties are renewing at around 7% more than last year.
Interesting.
And this increase in Class C property renewals is below the 8.3% inflation rate. I think this fact is a little bit of a sign of things to come. We may have heard a subtle undercurrent of discussion about housing affordability, but not as many direct comparisons of inflation and housing costs. I think the White House's recent plan, at the very least, signals that housing affordability has attracted political attention, and that's with renewals for affordable units rising less than inflation. If physics is right, if economic physics is right, you'd think that it would start to come to parity with inflation. And
that's on renewals, right?
Yeah, so that's on renewals.
Market rate's going up, but most people are staying, so they're only getting the renewal bump. Yeah.
So once that kind of comes at the level of inflation, I think that voices will start getting louder that are talking, and maybe some of these plans might turn into an action. Maybe not the specific action they noted, but it may be along those lines.
Yeah, that makes sense.
To return to affordability, and they do talk about these public narratives of affordability. RealPage has searched that affordable rental housing is separate from market rate apartments when we're talking about it. And I know that it's technically separate, but I want to get into the kind of conflict I see here.
Yeah.
It talks about public narratives around affordability. They conflate two very different issues. The real crisis is a severe shortage of affordable housing for lower income renters who've never been able to afford market rate even prior to COVID. We need substantially more housing of all types, but especially affordable housing, which requires more public support and more government funding. Yes, I think that there are specific apartment properties that are classified as affordable. That is a distinct group. But when you're talking about housing affordability, the vagueness of the term is actually a little more accurate, because a lot of people are feeling that it doesn't matter if what they technically, they're all
if they're getting government assistance or not.
They're all kind of gonna vote, and they're gonna approve of action that makes their house cheaper, no matter, or makes it cheaper to buy a house. I'm sorry. So the issues of affordability just don't go away if you're not technically in that group. There are going to be people that feel these effects, and so these actions will impact the housing market as a whole. And that's what I want to say too, is even if they target affordable housing, that group as a sector, I'd be hard pressed to disbelieve that it's not going to have I think that their actions in the affordable housing space will have an effect over the housing market.
Oh, yeah.
They're not just two independent areas.
Agree. Agree.
So I know that was a word salad.
No, it's okay. But on the same page.
I think that this was an interesting article, and that's what got my blood pumping when I was typing about it. I was like, I think that there is ample demand for housing across the board that's raising prices across the board, and whatever solution that we get, I just hope it doesn't create more of a burden than is already present.
Yeah. No, it's a tough nut to crack, and the idea of affordability is it can be a little ambiguous, because are we talking about subsidized housing? Are we talking about actual affordable, which is subsidized, or market rate that is kind of be affordable? A lot of developments have, Section 42. So there's part of it set aside to meet a certain AMI range for renters that qualify. But it all affects the broader housing market.
Yeah.
And so regardless of how you're paying or who's paying, it all is kind of supply and demand at some point, and everything certainly in the housing market is interconnected.
Yeah.
So I think it's a good point, Matt.
Yeah, you can't get away from it as much as you can, and that also kind of means that any effect that especially if it's a significant action, any effect that some of these actions in this housing action plan, anything they do is going to have an effect over the whole housing market. Unless it's kind of geographically limited, I think that So it's a big minefield.
It is.
Maybe it's worth just staying out of it.
Matt, awesome report. Really interesting articles. We're going to have to keep tracking this market, obviously, every day, every week. If you want to stay up to date, you can check on grayreport.com every single day. It continually is updated, but also, sign up for the newsletter, graycapitalllc.com/newsletter. Make a subscription to this YouTube channel to stay up to date, and give us a comment and a like, one that helps the channel, gets this information out to more people. But if it's a good comment, we're going to feature on the report. We like to feature good comments. We like to interact, and we'll respond. So I'm looking forward to interacting with you by leaving a comment below. We'll see you on next week's Gray Report. Matt, appreciate it again.
Thank you.
Have a great rest of your week. See you next week, everyone.